Hello, hello. What's up, everybody? Tuesday morning or afternoon, depending on where you're watching this from. But welcome. We will give it a few minutes and let people start piling in here and getting set up. And we will get organized for y'all. First things first, where's everyone tuning in from? Let's see. Okay. We're just getting settled here, letting everybody get set up. So first things first, while people are coming in, I wanted to bring up something really interesting. Our presentation today is on a decade of inflation ahead, how to navigate this, how to manage your portfolio and invest through this. And something really interesting happened is while we were going through this, the understanding is that most people, most news outlets, most investors, especially on the retail side or earlier investors, don't understand what the biggest headwinds are or crosswinds and drivers behind different economic forces, et cetera, that make up the economy that we're in now. That seems like it's changing and people are waking up. For one, we have presentations like these that are diving in deeper, trying to help explain that. But it was literally last night, this was posted by Reuters, that they are expecting the World Bank came out and said they are expecting a lost decade in global growth without bold policy shifts. So really interesting that they're putting this back on politics. That's a bold move, I'd say, because as we'll jump into here, politics has been relatively ineffective at fixing huge generational shifts in things like demographics or in capital markets. You know, the Fed has some really good tools that are really strong, but also it also is limited with certain things that it can do as well. So really interesting article in Reuters. There's a lot covering this topic that seems to be coming out more and more. All right. So we have people piled in here and more coming soon, but we can start the transition and start jumping into a little bit on the topic for today. And also drop where you're coming in from. Super interesting to see where everybody is coming from and understand where, topics like these are the most interesting for our viewers and our audience. Also, I'm going to repost right here, right on the bottom of the screen now, is my personal Calendly link. Okay. So I am personally handling calls for a little while. I've been on the acquisition side for a good period of time. And now I'm excited to talk to investors and help y'all out. If you're interested in learning more about Saint or have any direct questions that you prefer doing off the camera, etc. So I'm happy to do that. The link is, there we go. The link's right there. The link is below. It's also in the chat. It's also in the description of this video. So hit that link if you want to talk to me directly. Don't know how long I'll be doing that. Probably just for the early bird investors and kind of the top most interested Johnny on the spot investors for that. So I'm going to repost this link here, and so it's top of mind for everybody. Okay. All right. So let's jump into it. I'm going to transition and pull the slides up for you guys so that we can start diving in a little bit more. All right. Hello. Welcome, everyone. Welcome to this presentation. We are hosting on inflation. Let me pull this up here and get organized. We're also going to talk today about the economic and demographic drivers that are causing inflation and quite possibly the decade ahead of heavy inflation and turbulent forces that we are looking at. The goal here today is that you are investing successfully while other people are losing their shirts. Because the reality is we haven't dealt with this amount of inflation for decades. So we are not geared up as a society, as an investment group, as people that are going towards that. Excuse me, as a group of people as a society of people that are used to investing a certain way, it gets very complicated to shift away from that. So today, hopefully, we're going to give you some really good tools that you can put into work on your end and make the changes that you need to. To be 100% upfront with you, I am biased, but I think this information is nothing short of the absolute most important information that investors need to understand entering this territory we're going into as a country and really as a global economy. Most people are not understanding the bigger picture and instead are only seeing the snapshots of the exact moment that we're in today's market. So they're missing how it all connects on a bigger scale. Today, we're going to tie it all together for you so that you, the viewer, can put it together in your own lives and apply that to your investing. All right, let me take a sip and we're going to start jumping in a little bit more. So a lot of things that we'll go over today are not just for an interesting perspective on the market. They're things that work, right? This is how we at Saint have built the foundation of our investment strategies by digging into the markets, by digging into the economic data. And that has been really, really amazing for us, whether it's literally record-breaking years over years, where we're doubling properties in value year over year. We have returns many years in excess of 70% for some projects, and even projects that we still have in our portfolio today that have things like 50% cash on cash sustained and have been from the second that we purchased them. So this is big data and it has real consequences financially for the people that apply it. Equally important is to understand what happens during the bad times in markets, right? So for COVID, for example, while many people were having to navigate extremely difficult situations, we were actually repositioning literally the entire portfolio based on the economic drivers that we saw at that time. And I'm really happy and frankly pretty proud to say that we had back-to-back record performance years during COVID, no less, right? And we're still enjoying those successes today. So hopefully it speaks to the fundamentals and not that we're the smartest people in the world, but that we drill down more than the next group and hold the principles into our investing. Between many great years of returns and also by investors increasingly hearing about us and wanting to be involved, we have grown the Saint portfolio using these principles. Again, I want to harp on that as much as possible. We've grown the portfolio to over 200 million in assets under management, which has been extremely exciting for us, extremely exciting for the team, big wins across the board. And most importantly, we have been personally part of that success, enjoying that because we invest along with our investors. So just a little intro and something to think about along the way, and kind of just giving props to our team right now a little bit for a lot of hard work over the difficult and crazy years we've had the last few years. Before we get too far into the economic parts, it's probably smart to tell you guys a little bit about us and myself and the team. So a little bit about me. I'm a lifelong entrepreneur who has built and sold a handful of companies. And these companies have ranged from things that are very tech heavy, very compliance heavy, and very finance heavy, to be honest. So I'm extremely obsessed with strategic data trends and identifying the absolute most key aspects of what makes something work successfully. So while in the midst of running the last sets of companies that we put together and had really amazing rapid growth, I broke down what the level of success that drew those companies to that level versus the success of our real estate investments that we were running on the side. We were running both together, a high growth company and the real estate investments that we were building on the side with just kind of a small select group of investors, of friends and family. And what I realized and what I discussed with the team and what we all eventually really understood was that we were crushing the industries we were in and being very successful, but we were actually better suited for the real estate side because we created something on that side that was completely unique and that people weren't doing because we were applying things from different industries that weren't being seen in the real estate space. So we were able to apply those, boost returns, have a lot of success. And because of that, we sold those companies. We went full pedal to the metal with real estate and transitioned heavily into that, transitioning out of those previous companies and full-time into the investment side of real estate, putting our money where our mouth is and investing along with friends, family, eventually a bunch of investors, and finding success. So that's with that group. So it's been really a great experience. A little bit about our track record. So far, we've taken on over 20, almost 25 projects, right in that ballpark, using the economic principles we'll talk about today, markets all across the board from, many things we'll discuss. So we have a lot of experience. That includes all asset types of commercial real estate. So we have experience across the board. I'll talk about what our sentiment is today and what we think the best options are today and why we do what we do so that you guys get a look under the hood with the economic data, with the strategies, and with the thesis so that you can take that into your own lives and make your own decisions and strategies from there. I'm going to pull up one thing here to make sure. Let's see. Okay. So overall, our strategy, just to get an idea of how we structure things in-house so that you have an idea of where we're coming from and what these strategies look like when we're looking at the economic data. We structure our projects into two categories to help investors with their goals. And that's split between an income approach, where we're trying to build income opportunities for people and for our investors, and the other side is growth. So similar to how financial advisors structure things between stocks and bonds, stocks are for growth. They want that consistent high-end growth over a long period of time. The other half is that income side, that bond side, right? So there's different portfolio strategies with that. We do the same thing with real estate. It's the same fundamentals and it's the same concepts. So we found this to be much less volatile than the stock and bond markets. I mean, if you're looking at stocks even today, let's check it out, right? Down 1%, down 0.5%, down 0.25%. Across the board, stocks are been very volatile, especially with the things we'll talk about here, that doesn't look like it's going to change on the horizon. And I personally wouldn't bet on it and don't have an investment thesis around that. So that's kind of how we balance things on the real estate side. I really like that approach. It's very independent of the stock market and different equities that you don't really have a whole lot of control over. So we've had a lot of success there, highly recommended, and we're going to dig into why that has been successful. Before we get too far, we want to nod to our legal team. We want to read some things to you and make sure you understand the love language of our legal team, which is covering bases. So we are not investment advisors, and this seminar is provided 100% for educational purposes only. All investments involve different degrees of risk. You should be aware of your personal risk tolerance along the way and your personal financial situation at all times. You are free to accept or reject all or any investment advice recommendations made by us. All services that we offer are subject to market risk and may result in loss of your investment. As you know, a recommendation is not a guarantee for the successful performance of an investment, and we cannot guarantee against losses arising from market conditions. Okay, we love our legal. We got that out of the way for y'all. As always, whenever we're doing anything live and we're setting things up for you guys, please feel free to ask any questions along the way. The questions really add a lot of value, not only to you and your specific question, but also to the group and the viewers and everybody that is watching, because it gets a little back and forth. It's more off the cuff. You can drill down deeper on topics, and it also gives us an idea of what's most important to you. So that's important. We want to make sure we're tailoring the answers and content to what you need as an investment successful community. So ask questions, guys. At any point you want to ask a question, drop it in the chat. We're on 4 or 5 platforms right now live. So make sure you drop it in the chat. We will see it. We will get to you, and we will add that question at the end for Q&A. If it's something that's just super pertinent in that moment, we might hop in and answer it then. But more than likely, we're going to wait till the end for Q&A so we can go through everything at one time and give you guys the attention as a bulk section of everything. Let's see. All right. So the final note I'm going to make that we always recommend for any presentation of any kind is for you to get the most out of it and make it all about you, okay? You're the viewer, you're taking the time to view this, so let's make this about you right now, right? How do you make this about you? Excuse me. How do you make this about you, and how do you get the most out of what you're going about, and how do you get the most out of what we're about to go through here? This is what we recommend. Ask yourself 3 questions. The first is, how does this affect the US, the United States? That's the country that most of our viewers live in. It's the country we live in. It's the market and the environment that we are investing in. So ask yourself, how does this affect the United States? The second is, how does this affect you, the viewer, in your life with your money, right? Make it about you. Again, figure out how these things that we're going to go through here, the economic forces, the demographic forces, the change in capital structures, how these are going to affect your life and your investments. Please make it about you and do that. The third is, how can you invest successfully during this environment? Because at the end of the day, that's what we're talking about here, how you can improve and improve your investments and your success rate with your money, because a lot of crazy things are going on throughout the world, including here in the US. So make sure you're prepared, right? Let's see. Let me click over here. All right. Before we jump into a lot of discussions, we always like to use the best analogy I've ever heard of market conditions. I'm 100% borrowing this from Warren Buffett, okay? There's an old investment analogy of the river and the boat. So let's say you're standing on the bank of a wide and large and huge river, and you're looking down the river at a far distant point that you need to get to. You want to get to that point. That's the goal. On one hand, you have a kayak on one side, and in the other hand, you have a paddle. You are trying to understand the river's conditions because you want to get to that end point. In one case, you put the kayak in the river, you jump in, and you start off for your destination downstream. But when you enter the river, the current is going against you, and it's going against you pretty aggressively. You have to fight the current, maybe apply some different strategies, some different angles, some different things that you got to do to fight that current. And along the way, you're going to spend a lot of your resources and a lot of your energy to get there. It's going to take longer than it would have if you didn't have those conditions, but you finally get to that end point that you're trying to go. When you're standing there after, you're saying, wow, that was freaking brutal. And you know what? Frankly, it was entirely possible that if the current increased, you realize that you might never have reached that point that you were aiming for. Or even worse, that the current could have taken you much further away from that point that you were trying to get to on the river, actually putting you backwards. Or even worse still, that you could have capsized completely due to not having the experience or the skill or the resources to navigate through those difficult waters with those increased difficult currents, right? So the next option starts the same way. You start by gauging the current first, and then you enter the river into your kayak, right? But this time it's a little bit different. It's completely calm. The whole river is completely calm. There's no movement of the current. You paddle to reach your destination. You could paddle hard and expend more resources to maybe get to your destination a little more quickly, or maybe even further down the river if you really wanted to keep an intense pace and put out a lot of effort and energy. But there's something in the back of your mind that's nagging you. It's that this is a river, and rivers have currents. So why is this just sitting still? You know that most rivers flow one way or the other, and you're smart enough to know that it's a major risk not knowing if this current is going to pick up and carry you more easily to your destination or go the complete opposite and push you back even further on your journey to get to your point. So the lack of clarity that you have with this completely neutral river is actually extremely risky because you just don't know what's going to happen and it could go either way. The third option is obviously the best choice here in this analogy, and that's you analyze the current, you push the kayak into the river, you jump in, and you realize the current is actually pushing you to your destination. You can expend more energy to get there even more quickly, or you can be efficient with your energy and conserve it along the way. If you really wanted to push it, you could go way past your target goal and achieve something way further than you had initially planned. But the good news is that you're going to get to where you're going, even if the current shifts on you and starts to push back, because you have so much momentum and you've already made so much progress. Also, at the end of the day, you know that if you were to really, really, really push on it and use your resources, you could get way past what you were trying to achieve. So this analogy is pretty obvious when seeing the implications in investing. The current is the market, if that's not obvious enough, right? The economy, and in this case, inflation, are also the current. It's everything. It's all the things that we deal with on a global macro basis that are affecting our investment careers and affecting our investment decisions. So if you're not entering your investing with a strategy to combat inflation, then you are fighting against a raging current that is going against you, that you will have to fight against. And likely this current is going to be too tough for you to beat. The forces are too strong. So, however, also to point out, there are benefits from inflation that we'll go more into later. And there are opportunities for success in this inflationary period. The investors that understand this and invest with the current and go with the flow and that are not using brute force or luck, which so many people are right now, and adding luck into their investment decisions that they think they're going to beat economic trends. These people are finding success that are staying away from the luck, that are staying away from the brute force trying to beat the market. Going with the flow and understanding the flow of the market right now will make you more money successfully, period, and often with a lot less risk. All right, so let's jump into inflation and really start digging in. First off, let's start off with the basics here. What is inflation? Simply put, if you're here and you're watching this, then you're an intelligent person 100%, because that is the crowd that we seem to attract and the crowd that we like to deal with the most. But let's simplify just for the sake of framing this large discussion. Inflation is the economy-wide sustained trend of increasing prices from one year to the next. That's it. Simply put, it's the trend of the increase of prices from one year to the next. The easiest way to illustrate this and for you to understand this is to use a simple example of simple money. I'm going to check one thing real quick here. Make sure our slides are working. Okay, good. Slides are go. All right, so the simplest way to illustrate this, just think about a cheeseburger, something that you're going to see and you're going to do and you're going to eat on a regular basis if you're a meat eater or if you're just somebody who's aware of food that you're going to see out, right? Let's say that you can buy a burger for $2 this year and that inflation is at a rate of 10%, okay? Theoretically, 10% inflation means that theoretically, inflation means that 1 year later, that same $2 burger is going to cost $2.20, right? All right, not really a big deal, 20-cent difference. Well, not quite. Actually, quite a big deal, because now if you make the same amount of money that you did last year, let's use 100,000 just as a nice, simple, easy to calculate number. So let's say you made 100,000. Then if there's 10% inflation, then you lost 10% of your income in that period of time. Okay. So because you lost that in your purchasing power of your income, right? So, so now, even if you got, let's say, a pay increase of 3%, which is not uncommon, inflation has robbed you of that difference of that 3% to the 10%. That difference, that 7% difference, is actually a net loss in your purchasing power, which is essentially the power of inflation that's negative, right? So things are infinitely more complicated than this. We're going to drill down on a few different scenarios shortly, but the big takeaways here are inflation crushes incomes, cash, expenses, and careless investors. Those are the things that get crushed in inflationary periods, okay? Now, inflation also benefits things. We talked about that, right? Inflation benefits debtors, hard assets, and strategic investors, right? Those are things that, without a doubt, no question, always are successful in inflationary periods, okay? Now, let's jump into inflation in the US, along with a little bit of backstory so that we understand our own country's history dealing with inflation, okay? All right. Does anyone remember all the way back in mid-2022, inflation hit 9% year over year, 9%. So right now we're talking about inflation. You know, we used an example of inflation hitting 10%. We were not that far off from that, okay? Very close to that. Since then, inflation has been dropping. However, let me be the first to tell you, we should not get used to inflation dropping, okay? We're dealing with factors that create significant cross currents that complicate the inflation expectations by multitudes that ChatGPT, any AI, and especially not the Fed can be ahead of at this time. The inflation pulse from 2020 to 2022, right, where it peaked at 9%, that was mostly COVID related is the reality. All the things that we're going to talk, or many of the things that we're going to talk about here, are just slowly starting to kick in and add fuel to that fire. But about 2020 to 2022, that was COVID related for the most part. From the point here's an interesting point to think of so that you can understand what the drivers are of that. From the point that a society changes the way they fundamentally live and consume on different things, it takes the industrial, manufacturing, and supply chain sectors about 18, sometimes up to 24 months to catch up to the consumers that have just made that big change in their lives. Okay, now think about COVID while we're going through this, okay? During those few years, there were massive changes every single several months that completely threw off manufacturing, shipping, warehousing, supply chain, etc., threw massive curveballs into all of those, right? That was COVID. So, I mean, just think about this. There was the initial COVID scare in China. Then there was the COVID scare in the US. Then there were initial lockdowns throughout the US. Then there were initial lockdowns overseas in many key countries in the manufacturing supply chain. Then lockdowns happening in the US, mandatory lockdowns of businesses, riots that we had throughout the freaking US, mask regulations, partial openings, closures again in some areas. We had vaccines, we had anti-vax, we had multiple freaking boosters, right? So all of those things changed the supply chain. So when the supply chain has zigged and zagged so aggressively over a period of time, we have one of the greatest, so excuse me, I'm trying to organize my thoughts because this is that important. And then throughout all of those changes that we had, all of those things we just mentioned, there was also one of the greatest reshufflings of state migrations in the history of the US, okay? People moving out of big states, namely California and New York, moving to smaller states and newer states like the Florida, Texas, a lot of things in the Sun Belt. Those also reshuffled the deck completely economically in the US. And in the midst of all of that was the work from home movement, which, let's be clear, as much crap as the work from home movement has taken, that has literally partially saved the US economy from completely getting crushed by the business closures and the mandates and all the things that the government regulated during that COVID period. The mandatory government closures crushed literally tens and tens of thousands of businesses. And the reality is it was probably going to be a lot worse if the work from home movement didn't step in as successfully as it did. The implementation of working from home basically saved thousands of businesses and hundreds of thousands of jobs. To be straight up, let's not mix words on that effect. But all that to be considered, think about the supply chain impact of work from home alone, right? Are we working from home? Are we doing more home repairs because now we're spending more time in the house? Are we upgrading the internet and buying all the cables and boxes and Wi-Fi's that go along with that? Now we're homeschooling from home? Okay, great. But those take materials, right? There's materials and there's textbooks and there's all kinds of school supplies that are needed for that. But now we're buying a new home computer, right? So we're not buying new laptops, we're buying new desktops. Are we selling a car to take advantage of the increased used car market, et cetera, et cetera? There's more zigging and zagging just from that piece. Now, wait a minute. Employers want people back in the office, right? So now that person quits their job because they say, no, I like this work from home or even a hybrid schedule. So now they're commuting again, but less, but more, blah, blah, blah. At the end of the day, all of that had effects on the US and global supply chain, right? Now, if a manufacturing supply chain has to adjust these factors to the fluctuating demands that we just talked about, and that demand is literally all over the freaking map, and the adjustment takes 18 to sometimes 24 months, can you see how many different directions the market was being pulled at one time and how crazy inflationary all of those costly adjustments are at each step that cost each link in the supply chain money by having to retool, restructure, rehire, adjust their hiring, etc. Right? Not hard to imagine that. And to make matters worse, the global supply chain made things even more infinitely complicated. So now you might be relying on Italian leather, which then is shipped to China to assemble, which while receiving flame retardant petrochemicals from Germany, right? All of those things. If there's one snag, then that whole operation gets slowed down. Each supply chain, each thing that's in our markets today typically has numerous countries involved, each waiting for each other's inputs and investment and oversight into that finished good. So these complexities, excuse me, words today, right? So these complexities and inefficiencies build up with production, and each change causes increased costs by the supply chain having to adjust and retool along the way. And that ultimately is what gets passed on to consumers. That increase in costs, right? The increase of costs from one year to the next, that is what we're talking about. That supply chain is extremely inflationary. All that to be said, that's how we end up with empty shelves and quadruple priced eggs. And that's simply put, right? So now all this happens, but then in the middle of 2021, Arizona, Texas, Florida, a lot of the bigger states, and by the end of 2020, every single state other than California, which has its own issues, and I say that as a proud Californian, but every state by the end of 2021 had completely opened up in the post-COVID world. So here we go. That 18 to 24 month window of having to retool the manufacturing supply chain starts then in the middle of 2021. So if you fast forward today, it's been about 18 to 24 months, depending on the state. Remember, 18 to 24 months, 2021. So for the majority of intents and purposes today, where we're at this second, as of this recording, we have caught up to the COVID supply chain effects that happened from 2020 to 2022. Okay, that explains the previous COVID inflation where it peaked at 9%, like we talked about. So all those COVID headache disruptions being sorted out have really shown a major readjustment. We're winding down inflation, and that's what we're seeing today because inflation's decreasing. You see the Fed slowly patting themselves on the back, right? But that's not the end of the story. We're going to get to this next one. But that's not the end of the story. Remember when I said that we hit 9% inflation in mid-2022 and that we're not to get too comfortable with the current inflation slowly going down? Okay, let's talk about why. This is where it actually all starts to get ugly. The next discussion is one of the things that keeps me up at night, and it's one of the things that worries me about the current state in the U.S. Economy and really globally more so than the U.S. The discussion now shifts away from, wow, COVID was this crazy supply chain headache disruption, right? Now it shifts to, oh, damn, this is actually huge. And it's the entire country that's now being affected, and actually the whole world. This is a now worldwide issue, way beyond COVID, okay? And for one, any help from political, I just want to make this super clear. Any help from the political sphere is essentially non-help. Or worse than non-help is that it's actually hurting us. It's actually making inflation worse and the economy worse by politicians trying to get involved and make the situation better. Let's take the most obvious one, okay? And this is not political. This is strictly economic discussion here. For the intensive purposes of this, we're completely apolitical, okay? But let's dive into something called the Inflation Reduction Act. Okay. Now this act is supposed to do exactly what it says: reduce inflation. Okay. In addition to attempting to reduce inflation, this act is a massive effort to green electrify the system using environmental methods. This will take a ridiculous amount of industrial build out, infrastructure redesign, electrical distribution improvements throughout the systems need to be added completely top to bottom along the way. And basically, this will require an overhaul of all things electricity based if the goals are actually to bring this to reality. Now, to be clear, I would love if that's the case and we could snap our fingers and to have that set up tomorrow. I think the world would be a better place, to be 100% non-political, personal opinion, right? But this will require the building blocks of a system, including record amounts of copper for wires. That needs to be mined, right? I don't have the numbers in here in front of me. I think it's something like 12x copper needs to be done in a short period of time than we've ever mined in a single year in the history of humanity, okay? So we need copper for wires. We need exponential amounts of lithium for the batteries that we're discussing here. The entire supply chain needs to be not only improved, but also created for electric vehicles. We have several companies putting that together. Most of them don't have enough access to these raw materials, so they need to design the supply chain for themselves. And then you need to actually make and create the things, meaning manufacturing here. So that means factories, that means labor, that means training, that means warehousing and full production lines in place to put all this into effect. All of these things are inflationary by nature. Every single thing that we just discussed is inflationary by nature. So to achieve the Inflation Reduction Act goals, which are very clearly stated, inflation reduction, right? In order to achieve that, meaning the heaviest shift to green energy we've ever seen, meaning the heaviest shift to specific minerals and metals that we need, there's an absolutely mandatory period of very heavy inflation that's adding to our economy in the near future and the midterm future. So in short, the Inflation Reduction Act is extremely inflationary over the long haul, okay? I'm not saying I disagree with the goals here. Again, I'm just saying that for the title of the Inflation Reduction Act, really bad title, and the politicians are not going to help us on either side of the aisle to get this under control. They're not capable enough at this time, and they really don't understand the problem enough at this time. So, more or less, we cannot rely on politics to solve the issues that we're diving into and discussing. Adding government to this will only make things worse, as the cost of that swelling government also will cost more to the American people along the way, which will only add to the whole overpriced inflationary party. Okay, that's a lot to take in, but, okay, Inflation Reduction Act, but most importantly, so we understand what's going on at home and what the political effort is. Let's look at what's going on globally so that we can understand the bigger picture of that piece. So to understand inflation, we need to understand it on a broader scale of which key countries are really drivers of different pieces of inflation. Let's jump into the global factors and which countries we're seeing as the top drivers of different areas of different commodities and industries, because that will give us a good look at what we can expect. So first off, top of everybody's mind and what seems to hop in on the inflation discussion globally is always the Ukraine and Russia war. Not excuse me. There are a ton of effects on the global economy from the Russia-Ukraine war, but let's review the top effect that most people are missing, okay? Fertilizer. Wow, not that sexy, but extremely important when you understand what it's an input for. Fertilizer exports from Russia and Belarus are down 20 to 40%, depending on which fertilizer you're discussing, which nutrient you're discussing. And this is actually ridiculously big for the global agriculture market. This has been true for up to a year, to be honest, right? So this is not actually something super new, but most organized and larger countries, which are the ones going to be most impacted, have reserves for commodities like fertilizer. But these reserve amounts vary drastically depending on the country. And once those reserves are gone, they're gone. Okay, there's not double reserves. There's not secret reserves, right? So we're just now starting to see the effects of many countries running out of their fertilizer reserves, meaning their agriculture sector is about to get crushed in very real large ways. The lower supply then increases fertilizer pricing, which then increases the cost to produce the crops, and then raises the price of that consumer paying, of what the consumer pays for that end use, which is the agriculture produced by that by those fertilizers, right? So if prices are increasing, guys, what's that mean? That's inflationary, right? That's pure and simple, hugely inflationary. So that's Russia, Ukraine, something good to consider, but let's bounce over to the EU and see what's going on that side. Most importantly, let's talk about Germany. Okay, Germany, aka the largest, the most cornerstone economy in the EU, is extremely reliant on Russian natural gas. And that's offline. That is not coming back for Germany anytime soon. There are big disruptions in the German supply chain, particularly for German manufacturers and petrochemical companies. We will likely see a hugely reduced output by Germany for the respective industries that they lead. So think cars, think industrial chemicals, plastics, leathers, and industrial machinery components that literally the rest of the world uses for their own manufacturing. Okay, so what happens then? This leads to things being much more expensive because let me gather my thoughts here. This then leads to things becoming much more expensive, leading to price increases to the consumer, inflation, right? Or this leads to manufacturers and producers having to adjust their production with different parts and different materials, them having to retool everything and change their production line and change their production process. This costs money. This costs training. This costs re-education of their employees. So Europe is showing a lot of disruption ahead, especially from Germany, which leads the pack. Okay, how does this affect the US? Remember, one of the questions we're supposed to ask. We use a lot of German components, especially for manufacturing. Expect higher priced goods coming out of Germany. Expect higher price of those different components, and expect overall higher prices to us as US consumers. Okay. Now, lastly, on the global side, right? We talked about Russia, Ukraine, top of mind. We talked about the EU, specifically Germany, just one big example there. Now let's talk about China, which is everyone's favorite topic, especially politically in the US. It seems like that's a discussion that both sides constantly agree on, is that everybody needs to keep an eye on China, right? So let's talk China. We are likely to expect a lot of disruption of China, possibly more than from any other country in the entire world. Russia is cutting their energy output by 500 to 750,000 barrels per day. Okay, that's only about 10 to 12% of Russia's global total output. But as energy production tightens worldwide, this shakes the market up significantly. Okay, so why do I bring up Russia when I'm talking about China? Because China has been importing more and more crude from the Russians because it's been at lower and lower costs, because Russia has less buyers at this time, right? Most of the Western world has backed away from Russian discussions or Russian trade. So China stepped in and said, hey, we're getting a discount on oil. Let's do that, right? As this reduction in Russian oil exports goes on, that adds a much more expensive variable for China in getting the energy and oil that they need. That will only drive up the things that they produce, okay? Those added prices don't go to the manufacturer, right? Those go to the end consumer. Those get passed along the supply chain. So that's just one more reason why Chinese goods are going to increase and already are increasing in price, what we're seeing today. This energy inflation for the Chinese does not just affect the US, it affects the countries globally that China deals with because they're such a large exporter. And if the exported goods happen to be inputs for another country's finished goods, like let's say a piece of plastic that is assembled in China, a piece of plastic that's made in China but then assembled in Guatemala, then that other country, in this case Guatemala, those products will go up in price. Again, causing inflation to the end consumer, which if those products go to the US, which many of them do, that increases prices, more inflation. Now, that's just how China is being impacted globally. Internally in China, things are actually much, much dramatically worse. Okay, remember how China had that one-child policy for literally decades? Well, at some point that was going to have a major effect, and the intended effect was to, very simply, reduce the population. And while that is a smart goal at the time when you're running a communist one-party system, right? There's hundreds of millions that are going hungry at that time. So it's really smart to just reduce the population and make sure that there are less mouths to feed so that you can feed the population and also not get overthrown as a communist dictatorship, right? But China China did something brilliantly at the same time, okay? China shifted to a manufacturing-based economy around the same time, where their massive population of low-skilled workers could then be transitioned to a massive army of low-skilled manufacturing labor force, okay? So that's amazing. It was one of the best transitions we've seen a country do in economic industrial history. But when you combine those two things, okay, on one side, you're having exponentially less people by design. And on the others, the backbone of your system is low cost, cheap labor from a huge labor force. Something has to break. Meaning in this case, their entire country's success is dependent on two major initiatives that are fighting against each other that the Chinese government designed. Any guesses where this ends up? Okay. And with all these issues colliding, the end result for China is that they will likely see the end result for China, for us, is that we will likely see just less goods coming from China overall. And the goods that we do see continuing to come from China, we're going to see dramatic price increases over the coming years. So more inflation. To give you guys perspective here, we are seeing to give you guys perspective, we are seeing China's cost to produce as 3x what Mexico's cost is, okay? That's not a future projection. That is literally today's dollars. That's today's costs, okay? So already Mexico is beating China by a wide margin, and that's only going to get significantly worse as China's demographics get worse, all right? So while literally we could spend hours discussing this and the different inflation effects globally, we wanted to point out some of the key inflation pressures that you need to consider with the key economies in the modern world. And we discussed global inflation first because it will help us understand the next discussion, which is inflation pressures in the US specifically. On that note, let me get a sip. All right. With all the inflation and pressures abroad, the U.S. needs to adjust to these changes with our system that provides consumers, aka U.S., consistent consumer goods. Also, reliability that we need to increase the supply chain so that we know we can get our goods tomorrow, we can get our goods next month, and we can get our goods next year as the consumers in the U.S. In order to do this, with the most recent studies showing the impact in the U.S., we will need to double the size of our U.S. industrial sector and our industrial plants to offset the German, the Russian, the Chinese, and many other countries' disruptions that we see on the horizon that are not going to change. This is not something that we do overnight, okay? This is going to take literally decades to complete for us to put this whole thing together. And during this time, the pressures are extremely inflationary as the cost to move things from overseas to the US and build manufacturing here, it's not cheap. And the labor and the processes stateside cost more initially, with the labor being more expensive and those costs built in, and the cost of building out that manufacturing sector getting passed over to the consumers initially. But it is also the most massive opportunity, and one that will significantly benefit the US in the long run. So while it's a massive investment, it's also a massive payoff. But that depends on quite a few things, doesn't it? Here are some of the most key considerations that you should have at the top of your mind. Cost of capital. Money isn't free. You got to build all these things out, and that takes money, right? The labor force size and the price of that labor force that's going to be in effect. Demand for the goods and services at home. Is it going to be the same? Are those changes, etc.? There's a million things we can go over, but those are the top ones, right? So let's dive into understanding these forces a little bit more by understanding in the US, our population demographics. Okay, so around the age of 55, wealth in the US begins to boom. Why? Hey, can anyone take a guess? Think through this, right? I'll give you the biggest hint I can, which is expense reduction, okay? To put it more clearly, wealth booms at 55 because the largest average American expense goes away completely, or AKA it leaves the house. Your children, right? So when your children start moving out, you are beginning to realize the biggest wealth and the beginning of the biggest wealth net worth stage of your lifetime. Your biggest expense is leaving in your children, whether you have one or you have 20. The faster that they move out of the house, the more money you have in your pocket that you're saving. But also some other interesting things happen. At that same age range, starting at 55, this is the highest earning point of your entire career. And also, on average, you start paying your house down more successfully and more aggressively, because with your kids out of your house, you have more money freed up because your expenses went down. So you got to do something with that money. Most Americans are taking that money and they are paying down their house. So their equity is increasing, or they're paying their house down off completely. Their income's at the highest it's going to be in their entire career, and their expenses are at the lowest they've been in decades. That is literally the perfect storm for high net worth, and it starts at the age of 55 in the US. So all of that to be said, from the ages of 55, which we said, to the age range of 65 to 65, this is 70% of the money and wealth and net worth in the United States. It's very similar globally, but especially in the United States. This is where the money is, guys. This drives the entire capital market system in the US, okay? But remember, this is just a decade. 55 to 65 is 10 years to have your peak wealth. So what happens then, right? What happens after year 65? Well, then you slowly, or more rapidly, depending on your situation, move towards retirement. You move towards your retirement years. And retirement is not the same as age 55 to 65. Retirement is a period of completely different considerations, knowing that you won't have that peak income we just mentioned. that won't support your lifestyle. And your living expenses, while they just went down with your kid moving out or your kids moving out, they need to go down even further, because you really need to analyze what you actually need to live and what are just nice things that you can get rid of and be more efficient be more efficient with your expenses, right? So you're considering your expenses more carefully and likely spending less. But there's also the question of, with that money that you already have, what do you do with all that net worth that you have saved up, whether it's equity in your house or whether it's your investments that you already have? What do you do with that? See, in your retirement years, as we understand, you don't have the luxury of a long runway, right? You're towards the tail end. You only have a shorter period of time left. And you need something safer because you don't have that income we mentioned. So you need something safer and more stable and less risk-based. So like, think about the stock market right now, the turbulence in that is pushing the boomer generation away aggressively. We're seeing so much money leaving the stock market because many that are in the retiring stage cannot take that risk and don't have the time to make it up by the market, right? So you likely never have a chance to recover those amounts if you lose that. So what do? You go more conservative. It's what we've seen every generation before the boomers also do the same thing. You move into things like, stabilized, safe real estate. You move into things like treasury bills. You move into things like bond and a ton of fixed income investments, things that you can rely on to pay you as you need it, right? This is literally, guys, honestly, as a sidebar, this is literally what we made the same income fund for, right? This group right here that needs set amount of income that they can rely on, that's based on very secure assets like real estate in this case, and is completely isolated from the craziness of the stock market or tech industries or retail or anything like that, completely independent of that. The reason we do an 8% return on the income fund is simply put because it beats inflation, right? So you can get your investment, and for us, we have a structure so that you can get your investment back in 90 days. So we're trying to give people the flexibility, beat inflation, so you don't sit in cash, so you don't get crushed by inflation that's going on right now. You're not in the stock market. That's why we have the income fund set up. So you'll see fixed income investments that are tailored directly to this community that's retiring, specifically the boomers. Okay, I'm seeing a pretty interesting question that kind of hops in on this, which is brokerage fees on the income fund. Great question. No brokerage fees on the income fund. The income fund has zero fees. The income fund is literally pays out 8%. Okay, it's set 8%. No acquisition fees, no brokerage fees, no asset management fees. We tried to make it as simple as possible, so people that are looking at income opportunities see this as just the simplest, most reliable, trustworthy investment that they could possibly make. 100% real estate backed. Don't worry about tech or stock. So good question. I appreciate that. Let's see. So this has been the system for decade after decade and generation after generation in the US and frankly, the wider investment world. It's built on the idea that our country is growing, right? We're stable, we're growing, and our population base is consistent so that the retiring generation, in this case, the boomers, right? The baby boomers, they have the confidence of knowing that the younger generations, even though they might not like them as much, they have the confidence of knowing that there's a huge base of people in the younger generations that are going to keep the United States system on track so that the retiring generation, can enjoy their golden years in a stable system that's not having any fears of collapse. Okay. But then something interesting and unplanned happened, right? For earlier generations, this was very stable, but then the baby boomers came along, right? The same ones retiring today were a disruption in the US. Let's see if I can. Also, so here's a slide. I'll just put it up here for the same income fund to make positive that if you want to reference this, you can take a look, okay? Over 106 months of consecutive distribution periods. We have never missed a distribution to investors since we have been a company, since we've been investing, okay? Since we started taking investment capital. Over 150 million assets under management. We're right about 200 million today. So that's actually increased. Huge amounts of distributions to investors. 90 days return of capital. Get your money back when you need it, okay? So also the link to me personally, if you want to discuss more about the income fund, the link is in the description and in the chat now. So you can click that, you can book a call with me, and we can chat on investments and the income fund. But back to retirement here, to switch gears. Okay, this is the amazing graph that we have here. Men are on the left, females are on the left, men are on the right. You can see the breakdown of sizes of generations in the US. Now, I'm going to direct your attention to the boomers. Pretty massive growth period that the previous generations had to create the boomer generation. The boomer generation, the baby boomer generation, was the largest generation in US history by a large margin, okay? And because demographics matter significantly, in countries, and the prime years of the baby boomers, which we talked about, 55 to 65, for the largest and wealthiest generation in US history, just happened, okay? The question is, when does this massive baby boomer generation hit 65 on average? Meaning, when is the formal shift to baby boomer retirement, where there are more baby boomers beginning to retire than there are in the workforce? This is a pretty massive discussion and thing to understand when it's dealing with the biggest generation in US history. This will move needles economically, okay? Well, the answer to the first question is, when do the baby boomers reach 65 on average? The answer is at the end of 2022. So we have passed that. We are right now at this very exact moment on the other side, on average, of baby boomers being past their earning years and shifting to retirement. Every single day, more and more. And with them comes the massive amount of wealth that they are now moving from investments into retirement structured investments, okay? The things that are safer, the income funds, the treasury bills, right? The safe real estate, stable real estate investments. That's where money is coming from, the tech sector, with all the things that go along with that, into the safer investments, right? Let's point out some things. Remember how we said 55 to 65 was peak earning years, and that the baby boomers, let's see. Yes, and that 55 to 65 were peak earning years, and that the boomers were the wealthiest generation in US history, okay? Both of those occurred over the last decade, where boomers were in their 55 to 65 age window, right? What else this is super important. What else happened over the last decade? We had the most abundance of inexpensive capital that we have ever had in US history over that same last decade, because boomers were investing heavily, with them being the biggest generation and the most wealthy generation. They were investing, and they were hungry for returns in the market. But as we said, boomers are now over 65 on average, and they are shifting to retirement now. So it is done. The flip has already happened. The switch has been flipped. Every day, more boomers are moving to retirement. So when this transition occurs and the boomers shift to retirement, which is what's happening now, what will happen to their wealth? Well, it's what we discussed before. It goes to secure, fixed income, dependable strategies like we talked about, and it goes towards saving and spending to monitor and to keep up their lifestyle. Because boomers are saving their wealth more tightly now and will continue doing so every day from here on out, and they're using much less money to invest in riskier opportunities, they're holding wealth and only trickling it out to support their ongoing life needs. We are seeing a massive shift to storing of wealth that is generating slowly but steadily more and more increases, because there's less money, increases in cost of capital, right? This is because as capital becomes locked up by the boomers, like we said, in all these safe, less risky, not open market investments, it will continue to push cost of capital up. So how bad is it, right? How bad are we looking at? Well, if you're looking at 2021 numbers being near record lows for interest rates, which was about 3%, the estimate of the best of all time interest rates are that is going to go up by a factor of 5. Okay, 5 times 3, that's 15% interest rates that are being discussed right now. As you know, maybe some more extreme groups might even think more than that, but that's not out of the discussion if you think about the crunch that's happening now on capital. Meaning that mid-teens interest rates at least may be where we're trending slowly over the coming years if something doesn't change. And also, here's something to point out. This is completely independent of anything the Federal Reserve does or has done. This is 100% demographic. This is a demographic driver, not political, not banking, and certainly nothing the Fed can do about some of the demographic changes. So just as a reminder, the Federal Reserve, fueled by the Trump and then the Biden administrations, went through an 18-month period where they printed 40% of every US dollar that has ever existed. Okay. We've talked enough about inflationary trends. That is probably the most inflationary thing you could think of, right? But all of those things are in addition to the demographics that we just went over with the baby boomer generation. So we know we're going to have high capital costs ahead and increasing for a little while, or maybe a mid-while, maybe a medium term, right? Because we're going to have to wait for another large generation to fill in the gap in the wake of the baby boomers. I'm going to go backwards and kind of go off script a little bit and show you guys again. So you see the boomers, Gen X, millennials, Zoomers, which is Gen Z. Look at the sizes of these generations, okay? That's what we're going to talk about now and the impacts of that. So we'll jump in here. So after the boomers comes Gen X, right? They're an amazing generation. They're very educated, a lot of unique skills that we have not seen before in US history, but Gen X is a good bit smaller. Look, let's see. That's a good chunk smaller than boomers, right? So they're a good bit smaller. They're a good amount smaller than the boomer generation. They are not going to be able to fill the gap left by the boomer generation. After Gen X comes the millennials. The millennials are the next large generation in the US, and they are by a wide margin, the next largest, okay? While the boomers set the record for the largest generation in US history, the millennials will beat them by their sheer size of millennials being a huge generation, okay? But something important to understand now we're going into all this is the workforce implications of size of generations, right? With the boomers being the largest generation, it also means that they had the largest workforce, right? So the US, the country as a whole, benefited from a massive labor force where labor pricing was relatively low. The boomers had a huge number of kids also, which is the millennial generation, but Gen X is smaller than the boomers. And they also had a smaller number of children, right? Which produces, drumroll please, Gen Z, the Zoomers, the smallest generation we have ever had in the fully industrialized US world, okay? And guess what that means for our workforce that we just touched base on? It means that Gen Z has the smallest workforce, significantly smaller than the generations preceding them, even Gen X, which was small, right? To make matters worse, Gen Z is also the lowest labor participation rate we have ever had of a generation in US history. They are here. They're becoming adults, and they're becoming adults that don't really want to work, okay? Don't believe me? Where do you think the discussions about universal basic income are starting? Free college, etc. It's a new perspective in the country completely that only a new generation can bring. and they will simultaneously be the most educated they will simultaneously be the most educated generation we've ever had, while also being the least working generation that we have ever had in US history. Okay? But hold on, we are not done yet. As the boomers, the largest generation, right? Largest generation by a wide margin, as they leave the labor force, they leave in their wake many jobs that need filling. That's not a surprise, okay? We've known that for many years. But behind them, entering the workforce now, is Generation Z, Gen Z, Zoomers, the smallest generation with the lowest labor participation rate that we've ever had. That means the amount of people leaving the workforce is significantly smaller than the amount of people entering the workforce. This is a problem, okay? And it's a problem that will continue to get worse over the next decade. It will not get better. In 2022, the last full year that we have as of now, the difference between the boomers exiting the workforce and the Zoomers entering the workforce was a disparity of 400,000 workers in that year alone, okay? 400,000 in that year. That number is going to continue to increase over the next dozen years until 2034, where it will peak at 900,000 boomers leaving where it will peak at 900,000 disparity, 900,000 worker disparity between the exiting boomers and the entering Gen Z generation. And this will continue from that point, although it will slowly trend down. So we have 12 years of those numbers increasing and trending down from there. So the bigger question is, how do we know this? These are a lot of crazy, scary numbers. How do we know that these are real? Because Gen Z is already here. They exist right now. They're born. They're adults. We know our population count in the US. We have survey data, and we know how many working age Americans are going to be of age while the boomers, which we also have a count on, are exiting. We know what the next 20 years looks like demographically pretty clearly. So we know that, one second, let's see. Okay. All right. So we know that 2034 is the year that will peak with labor issues of the exiting boomers and entering Zoomers, right? So what does that mean for us, and what does that mean for inflation? Well, it means actually quite a bit, because the labor force pricing is largely determined by supply and demand, like anything in economics, right? A large workforce equals large demand for jobs with a limited supply of jobs. That's deflationary. When you have that huge workforce and jobs are paying less, brings down inflation, right? When there's a smaller generation, though, there are more jobs available than there are workers. So that dynamic flips, meaning a situation where there's higher job supply than demand for jobs, meaning a smaller generation that doesn't want to work as much. That means employers will pay more to bid on the shortage of workers available, trying to entice those workers to work, right? If everyone is now making more money, a smaller generation with tons of jobs available, right? This is inflationary at the very, very, very basic entry-level job level, okay? Super inflationary. Yet another major demographic trend adding to the dog pile of inflation causes that we're dealing with now. And it will be about a decade of headaches stemming from this before it gets better. Okay, but here's a little bit of good news. Okay, not great news, right? It's not like the best news we've ever heard, but it's we just went through a lot of bad news, and bad news always feels a little less bad if we can compare that to other people that are doing worse off than us, right? Misery loves company, but misery really loves people in more misery than us, okay? So let's look at some examples of what that might be. Here's a comparison of the rest of the world, the top 4 economies in the entire world, okay? Oh man, I wish I could zoom in here more, but hopefully you have a good view of this. Hold on, let's see. No, I can't. Okay. If you think the US is in a tough spot, Look at the other three biggest economies in the world, okay? The blue arrows are the millennials, showing the generation size and when we can expect the gaps to be filled left by the boomers, right? Boom, very clearly shown there, okay? Look at what the others have. Look at the other big economies. This is the good news here. When you're looking at these, the bad news for the other countries, China, Germany, Japan, their demographics are falling off a cliff after our millennial generation. Their equivalent, they don't have that boost like we had. And their future generations are getting exponentially smaller, right? So here is the good news. We are demographically in the absolute best position in the developed world without even a question. And as a matter of fact, it's not even close, okay? While we are dealing with an annoying decade ahead of workforce inflation due to minor labor shortage, increased cost of capital, due to baby boomers pulling their money out of the game, the rest of the world is looking at significant questions of how their economies will even function moving forward. Some with 50% smaller labor forces, top-heavy, massive elderly populations that need support and need funding and need to be taken care of, and shifts away from industries that were the backbone of their economies. Think China, think Germany, right? We in the US are not dealing with this. This is not what we're dealing with. In comparison, we are dealing with short-term to mid-term, realistically, maybe some long-term, but mostly mid-term disruptions that will simply change the way that we do things for a while. The risk of, and let me be clear on this next point, because I can't say this of other countries, the risk of systemic collapse in the US is not here. The other countries, I think there's a big argument to be made that China has serious systemic collapse concerns right now. That's not the US. We don't have those demographics. That's not the GDP concerns, the economic concerns. And globally, these major disruptions that we discussed do one thing above all others. They bring industry and jobs back to the US and North America. Now, I'm going off script a little bit here, but let's talk about Mexico for 5 seconds. Mexico has the best demographics of its class in the entire world. They beat Brazil, they beat Turkey, and by the way, they're our next door neighbors. And by the way, we all benefit, meaning all of North America benefits from that long-term, decades-long relationship that we will have with Mexico as our industrial partner and as the U.S. as the industrial partner. So just an aside. The whole process ahead is going to be painful and it will be laborious, but it will be a good one ultimately for the U.S. And the light at the end of the tunnel is brighter for the U.S. than anywhere else in the world, bar none, no question, even with these massive shifts occurring. While the next decade is going to be a bumpy one, it's going to get easier as the world goes less global. It will become easier with the U.S. becoming more independent and self-developed in the necessary sectors that we need. So for me personally, geopolitics and global economics are a big hobby of mine. And economics is a necessity, especially U.S. economics is a necessity for Saint to invest accordingly. So I'm literally always looking at all these different data points to see how the U.S. and the global economies are moving. For me personally, again, just for me personally, I have three kids, 2 here, 1 on the way at the time of this being filmed. I don't know, man. I might have a lot more in the future. But right now, 3 kids, and I am not able to move around like some digital nomad, bouncing around the world and traveling and living in different destinations. I am bunked in with my flag planted. I have a large family. I have a good number of kids, plan to have more, have a large family, extended family. I am only looking for literally the best country in the entire world and the best markets in the entire world and the best opportunities for future generations, okay? My mountains of personal research and investment experience, I'm telling you, the U.S. is in the best position from everything that I've looked at. So that is the good news here. Okay, we said there were 3 things we wanted to discuss in the beginning. How does this affect the U.S.? How does this affect you, right? How do we make this about you? And the third is, how do you invest? How do you make money during all of these big changes that are happening? So With all that said, we know there's going to be pesky, persistent inflation ahead. So even if the US will come out on the other side better than ever, what do we do about this short to medium term inflation, right? The good news is that during this inflationary period, it's not like everything is going to suffer equally. There will be some big losers, there will be some neutral, and there will be some big winners. There will be some big winners, to be clear. Firstly, if there is a boom in the industrial sector in the US, which commercial real estate sector is the one best positioned to take advantage of the industrial sector growth? Meaning, if industrial industries boom, then what type of buildings should you be buying or investing in as the investor? For us, it's pretty obvious that the investment strategy is industrial real estate, okay? So that's literally 100% open kimono, so you understand Saint's strategy on investing. We are doubling, and look, we're doubling down on U.S. industrial sectors at a rapid pace. There will be and already is extremely high demand for industrial buildings, some markets booming, okay? And not to drill down too much on this, but we are positioned ridiculously well at Saint for this boom because we've seen it coming from a long way away, okay? The two bets, again, just as a little, a freebie here, the two bets that we see as the highest value in the industrial asset class, in heavy industrial, okay, the really, really heavy industrial products, the manufacturing, the the mining in certain markets, etc., and also light industrial for the distribution and for the supply chain and the warehousing of goods. So those are two things we're very heavily invested in. But wait a minute, let's back up and look at investing with inflation and high interest rates overall, because we can likely expect that in the future, right? In a high inflation environment, there are typically three asset classes that fare the best with the volatility that we expect coming up. Those three asset classes are gold, commodities, and real estate, right? No, I'm sure that's probably not a huge surprise to you, but just to go over the basics. Now, I've been hearing people make the argument for gold for decades, okay? Every time there's an economic hiccup, gold commercials start coming on mainstream media. The conspiracy theorists start talking about gold and money, the conspiracy theorists talk about money disappearing and runs on banks and all that stuff. But think about gold for a second, right? Really think about just literally the metal, the mineral, the gold, the gold, physical gold. It has much literal utility than other metals, meaning gold is not used in as many important components or computer chips or other necessities as other metals. Some have much higher utility than gold. Even silver is significantly more widely used than gold. So gold isn't super valuable from that aspect, right? It doesn't produce cash flow, by the way, right? If you have a whole bag of gold coins, you're not making money just holding that gold, right? So holding gold means you're literally you're investing knowing that you are not going to make cash flow on that investment that you made, and that your money is now tied up in an asset that's just sitting there, right? And its appreciation, gold's appreciation, to be clear, is dicey historically. The charts have missed numerous predictions, and there are even multiple moments in history where the gold and inflation did not correlate. They completely were out of correlation. So there's even more uncertainty there. It's not 100%, guys, right? And gold from a logistics perspective is dicey. I mean, just think about our audience. We typically attract multimillionaires, very successful, high net worth individuals, which means they have a lot of money, right? Which means if these high net worth individuals that we work with regularly move into an asset class, it would likely be for millions of dollars, right? They're not doing small moves. So do you know what millions of dollars in gold looks like, right? And so let's say everything hit the fan. Would you want to carry millions of dollars of gold around with you to use as payment with all your different stuff, right? No, it's just not realistic, especially for the high net worths with just more gold that they'd have to buy. Overall, I place gold in a resoundingly speculative category, as there are just way too many concerns, and there's not demonstrated utility or industrial need for it that I can see or see a good case study of. The storehold of wealth theory is something I'm still even uncertain of with gold. So it's just not a big bet, to be honest. For me, it's just not a big bet. So what about commodities? It's a little simpler with commodities. Here's the good news. Commodities do have advantages that gold does not have. Namely, they offer very tangible and very real, they are very real and they have legitimate utility. Meaning commodities like wheat and pork and oil and industrial metals, etc. They're all commodities because they have mass value worldwide, okay? So as prices of things inflate with inflation, right? Prices increase, commodities typically on average rise with inflation. So in that way, there's a great hedge against inflation by going with commodities. That's pretty good, right? They are real, so they have real case studies, so they have real value. That said, commodities have some really legitimate disadvantages. First off, where are you going to store them, right? If you have a truckload of bananas, I mean, where are you putting the bananas, right? I don't know, right? Or how do you transport them? Are you going to start a transport company or handle those logistics for that? What about for 200 barrels of oil or 3 tons of crab legs? Again, probably not having all that set up, and it's probably not realistic for you to invest in 2 tons of crab legs, right? Also, there's no cash flow on corn, guys. If you have a truckload of corn sitting in your driveway, you don't wake up with more money in the bank or additional corn in that truck. It's the same amount and maybe even less because corn goes bad. A lot of commodities go bad. So let's make a quick pause at this point. I think it's important to make some notes on this. Gold, commodities, real estate. That's what we said, right? What do these have in common? They're tangible, they're real, you can touch them. They have use cases, they are real, right? Stocks are not a real thing. We just need to point that out at this stage, that stocks are a conceptual ownership in a company. And that company might have massive problems dealing with the very inflation that we're discussing. We don't really know, and oftentimes we don't even know the discussions going on in closed doors rooms, which is why we're surprised by so many companies going under, or SVB. We wake up one day and it's good and it goes under the next day, right? For instance, how's tech doing right now? It's a slaughter, right? The tech markets are a slaughter because it's too conceptual oftentimes. It's not real. You can't touch it, right? I mean, do we really need the next Uber of dry cleaning? Please, anyone. Do we need the next, and when we're going through that, right? The next Uber of dry cleaning, going under and tanking, are consumers more likely to pay for, a premium for the Uber of dry cleaning? Or are they more likely to pay for their groceries in inflationary times? Or when layoffs are happening tens of thousands at a time? Do you expect Peloton stock to go up when people don't have jobs? I don't, okay? I think that's a really bad bet. And at the end of the day, this is why Saint invests in what we invest in, right? We are not going for we are not going for the big, sexy, glamorous growth projects like the Uber of Pelotons or the Uber of dry cleaning. We're not going for that. Instead, we are keeping it as simple as possible, investing in core foundational aspects of human life and the American economy. That's it. That's why we do what we do. So is there anything safer than we can beat that to death. We can talk about that forever. So all that to be said, that's just to give you a little perspective on these items versus speculative items. So real estate is the final hedge. It's the final discussion, and it's the ultimate. But I wanted to frame that discussion. So let's go down the same checklist. Does real estate have a need? Well, yes. People literally need to live somewhere. Companies must manufacture and distribute products, especially in a country that is going through a huge industrial and economic growth period. Does it cash flow? Yes, real estate cash flows. It has cash that is paid out by rents. If you do better, you make more cash flow. If you make worse investments, well, you might not cash flow at all, or it might be less, but it cash flows. Does it appreciate? Yes, 100%. If you invest in the right markets, you can benefit from appreciation. And does it protect you from inflation? Yes, 100%. Real estate has proven to be literally the number one hedge against inflation in many, many inflationary historical periods. So this evaluation of real estate is the head and shoulders standout above the other assets. That's why real estate's the standout above others in inflationary periods. And that's why we bet on it as the number one asset class 100%, right? Okay, we've spent an incredible amount of time analyzing the economic and market data, and I'm extremely proud of our performance, not just on the past projects that we've done, but also on the current projects we're in now and on the deals we're looking at. For those of you that have smartly focused on the inflation-resistant investing, our income fund has proven to be consistently the single best balance of stable returns and flexibility that I have seen in the market 100% period. So if you're looking to invest in the income fund or you want more information, there is a link in the chat and in the description where you can book a call directly with me. I'm taking investor calls directly right now for a short period of time. We've opened the fund back up. Usually we only do it quarterly for a short period. We're usually oversubscribed with the waiting list. Haven't talked to investors in a while personally, so I will be making those calls. So hit that link if you want to talk directly with me about investing into the income fund that we have open now for a short period. Only open it up once per quarter. Okay, so that wraps up the actual presentation for today, and I want to get to Q&A as there are always a ton of really, really good questions that happen on the fly in the Q&A portion. So as a final wrap up, just to kind of check some boxes here, we will offer this presentation as a replay for those that have signed up and attended today. We'll probably send this out in the next week or so. Is typically kind of the time frame that we put that together. But sometimes it will be delayed if we want to make sure that this is an exclusive experience and get the calls out of the way with the early investors that want to have those discussions. Again, the link to book a call is in the chat. It's in the description below. Let's see what else. Okay, this description, or excuse me, the education and information that we provide here is always going to be free and available, but our investors see it first, usually by a good clip before the general public. So it's worth getting in on our newsletter and checking that out and being a part of that so that you know when we're doing these in the future. Typically, we're doing about 1 to 2 per month, different webinars right now on really big topics to help you as the investor navigate through. Let's see. Okay, catching up here. To help you guys navigate through, right? So if you want to watch previous presentations, we have all of our previous presentations, tons of videos, tons of valuable blog posts on the website at saintinvestment.com/resources. I'm going to put that in the chat now, and that will be in the, that will also be, there we go. I should put that in the chat. That will also be inside of the description below on this repost of this video. All right, let's see. So let's transition to Q&A, huh? Let's answer some really cool questions. We've had a ton. Also, we're on multiple platforms, 4 or 5 platforms. So, if you don't see questions, or I might not see questions in that chat, but I also have some from other different platforms that we'll hop into now. Let's see. All right, I'm going to put this on in the background here as the kind of landing page while we kind of go through some of the Q&A. So first, I love this question. I love this question. What are your top U.S. cities for industrial investing currently? Okay, this is why I love Q&A, because the good stuff, a lot of good questions come out. Okay, so we invest in industrial. Let me start there so that you understand the bigger picture. We invest in industrial for all the reasons we just went through in this pleasant presentation here. And so for industrial, there are 2 markets that stand out for special reasons. The whole U.S. needs industrial real estate. There's a ton of infrastructure from industrial and imports and distribution. But I talked about Mexico very briefly. And I talked about how Mexico will be a key trading partner for us in the future. So because that's the case, south of the border and north of the border, those border territories in both countries are going to be extremely key in the upcoming markets and the upcoming economies, how things shift. So for us and where we're investing right now and what we love beyond all other markets in the U.S. are 2 markets, okay? The first and the absolute standout is Southern California. And we say that generally speaking because it's a little bit of everything, but it includes Los Angeles, Orange, San Diego, Riverside, and San Bernardino counties. We particularly love the Inland Empire. Why? Because it's positioned near the border. So as Mexico ramps up, those imports will be going through, will land in the Inland Empire markets, which is Riverside and San Bernardino, and transition and distribute throughout the Western, Southwestern, and Midwest U.S. Okay, so number one market is Southern California, specifically Inland Empire. Number two favorite market for industrial real estate is the Texas Triangle in Texas. That's Austin, that's San Antonio, and that is Dallas. Okay, that triangle right there, we love beyond measure, because there's so much innovation happening. There's so much industry, so much manufacturing. Texas is an amazingly business-friendly state, and also it covers the east coast of Mexico. So manufacturing on the east coast of Mexico comes up through there, distributes from the Texas Triangle to the eastern, northeastern, and mid-United States in a really efficient way. So by far, no question, Inland Empire markets in Southern California and the Texas Triangle as my top two industrial locations and markets for investing. And frankly, that's what we invest in, right? Like that's what we specifically do. So actually, I'm going to put this back up. Make sure that's there. Oh, great question. What do we think? So do you think the Fed will continue to raise interest rates for a while, or do I think they'll stop raising interest rates? Do we think the Fed will continue to raise interest rates for a while, or do you think they'll stop? Okay, this is amazing and couldn't be timed better with everything going on. We see this freaking discussion on every news channel. It's, they bring on all these random people. Everybody wants to make crazy claims. I'm going to tell you with a high confidence interval, this is what I believe they should do and what I believe they will do. And having many bank CEOs and close friends that are 1 or 2 degrees away from literally Jerome Powell, that's the feedback that I'm getting that the Fed is understanding right now, is the following. If the Fed stops and pauses rate hikes, okay, if they pause rate hikes, something interesting happens. That signals to the market that they believe that there's some weakness there and that they will not be hiking rates in the future, right? If you stop hiking rates now for each interval, then that sets a trend of those not happening in the future, that when they raise rates in the future, that is a huge negative impact on the market. Whereas if they just increase rates consistently by a small margin, then they're achieving that downward pressure on inflation. They're achieving what the Fed wants, which is a bad economy, right? And they're doing that whole thing to make sure that they keep that momentum of rate hikes. I do not see rates being paused. I do not see them being dropped. I see rates continuing. Also, this presentation, we talked about the biggest reason is that 2020 to 2022, like we talked about, most of that inflation was COVID caused. If you want to know the details, go back in this video we went through in depth, which is the short answer is lots of disruptions in the supply chain. Those are fixed now for the most part. We are moving towards the inflation we're dealing with now, which is bigger. It's demographic. It's national for the U.S. So if the Fed pauses rate hikes, inflation will go rampant, period. So I believe that the Fed, with a high degree of certainty, will continue minor rate hikes unless inflation starts ticking up, and then they will increase the rate hikes to do that. Where do I think they'll stop? That wasn't a question, but where do I think they'll stop? I think they're going to engineer a recession. I truly do. That's my bet. I think they want to get this whole labor market under control specifically, and with the boomers leaving in droves, up to 500,000 a year right now, and a differential of 500,000 a year between boomers leaving and Gen Z entering the market for work, I think that it's going to be really inflationary. I don't see rates pausing or stopping or going down anytime soon. Let's see. Any other? Oh, I love this question. What's the best retirement strategy right now with inflation ahead? That's an excellent question that we got. To me, it's without a doubt, it's going to be further. It's going to put distance. If I'm retiring in the second, I'm getting distance between me and the stock market. Okay. It's just too turbulent, and there's too many factors with upcoming inflation, labor shortages, etc. I don't trust the companies or the underlying value that they have by buying that stock. That's not where my money's going. It is going in set, stable, inflation-resistant investing. So to me, 100% confidence, it's real estate, okay? And it's real estate assets. So I would do, for me personally, what I plan on doing and what I'm doing now is having a balance of stable real estate that's backed by a literal physical asset that has a longer term where you can make more money. So like maybe a 5-year fund, so it ranges between like a 12 to 15% projected return that pays cash flow, that has big payments on the end of that. And the other is the income fund model. I keep harping on this because that's where my money's going right now. Literally, I'm putting money into the same income fund, my own funds, because I believe in it that much. It's 100% real estate backed. I love that model because it pays you every month. Okay. When you need your money, you get your money back in 90 days or less. So I'm doing the same thing that I'm recommending to investors, because when the market shifts further down the line, we don't know exactly when that looks. I can get my money back in 90 days. I can adjust as needed, and it's not this long commitment or a turbulent thing like the stock market. So I'm buying income investments. I'm personally investing in the state real estate income fund, and that's where I'm putting my money right now. What is my least favorite asset class within real estate? Oh, man, that's touchy. I have so many that I dislike so much because all for different reasons, right? I love real estate as an entire asset class without a doubt. I think it's head and shoulders above everything else. But I would say for me personally, you need to go bigger. That's how I'd start off by saying single family. While you can invest in single family, and there's business models and investment models that are very interesting around that, it's too small, right? It's too freaking small. You want to talk about economic drivers, right? Things that can knock you off and make you lose a lot of money. What if you had one tenant and 1,500 square feet and 3 beds and 2 baths, right? Like, I couldn't imagine a scarier scenario of investing than having a 100% or 0% occupancy in a house. It's just not for me, right? If you're talking commercial, so single family is the lowest on the totem pole for me. If you're talking commercial, man, office, I think, is just, it has too much of a shakeup ahead of it. It's just not what we're putting money or effort behind. Retail, I think there's a huge use case for, but it's market to market. And I'd say that right now, I would say I have so many good, dear, amazing friends in multifamily, aka apartments, but it's just too heated. There's too many people in it, right? It's too competitive for the rates being too low. It's just too crowded of a space. So there's goods and bads to all of those. For us, industrial's head and shoulders the best, not even a question. We have enough properties that we level out any vacancy concerns. The markets that we're investing right now have a 1% vacancy rate. Okay, 1% of a year. Okay, that's 3.6 days. So if we lease a 200,000 square foot building, we need to lease that. We wait 3.6 days statistically for hundreds of thousands of dollars in rent every. So, anyways, real estate. I'd say those are my order of operations of things I like in real estate, with industrial being aggressively at the top of the heap. Let's see. Yeah, a few others, but I think those are the best questions that we got so far. If there's any last minute questions, hit now while we go through a wrap up here. Let's see. Yeah, I think we're good. I think those are amazing questions. If you have more questions, or you want to specifically talk about investing with Saint, or learn more about what we're doing, there is a link. I'm going to put it up here one more time. Calendly link is being posted. You can book a call directly with me. I only do this randomly, occasionally, when I want to talk with investors directly and understand and help people navigate through their investment things. I think it's a critical time. I want to be more front and center with investors at this time. And also, we only open up the fund quarterly. So the income fund is open now. Hit the link if you want to check it out. The link's going to be in the chat. It's going to be in the description. And I hope to talk to you guys soon. That would be fun to connect and talk more about investing. So cheers. We appreciate you guys. The replay is going out in the next week or so. And if you have any questions, feel free to reach out.